Let me start with a direct statement that will make some viewers uncomfortable. Right now, there are credible analysts, seasoned investors, and financial institutions quietly positioning for a scenario most people dismiss as impossible: precious metals prices reaching levels that would fundamentally reshape wealth distribution in the modern economy. Silver at $300 to $500 per ounce, gold at $8,000. Before you dismiss these figures as sensationalism, let me be clear about what this video is and what it is not. This is not a prediction. This is not investment advice promising guaranteed returns. This is not a sales pitch designed to create panic or urgency. This is a sober analysis of the structural forces currently converging in the global financial system, forces that create the mathematical possibility, not certainty but possibility, of precious metals reaching price levels that would have seemed absurd just a decade ago. You're watching this video because something feels different. The financial landscape has shifted beneath our feet, and the old rules no longer seem to apply with the same reliability they once did. Whether you currently hold precious metals, whether you're considering entering these markets, or whether you're simply trying to understand the strange signals emanating from the global economy, this conversation matters. Over the next 25 minutes, we're going to examine why serious people are discussing these price scenarios. We're going to look at historical precedent, current market structure, and the macroeconomic forces that could, under specific circumstances, drive precious metals to levels most investors consider impossible. More importantly, we're going to discuss what this means for you, regardless of your current position. Because the real question isn't whether these prices will be reached. The real question is whether you understand the forces at play well enough to protect yourself and potentially benefit, regardless of which scenario ultimately unfolds. Let's begin with the foundation. To understand why experienced analysts are even discussing these price levels, we need to establish what has fundamentally changed in the global financial architecture. The world you're living in today operates under monetary conditions that have never existed in human history. Think about that statement carefully. Never in the thousands of years of human commerce, trade, and economic organization have we seen the combination of factors currently at play. Global debt levels have exceeded $300 trillion. Central banks have expanded their balance sheets by tens of trillions in just over a decade. Interest rates in major economies spent years in negative territory, meaning investors were paying governments to hold their money. These aren't normal conditions. These are crisis-level interventions that have been maintained long past the crisis that justified them. When we discuss the possibility of precious metals reaching multiples of their current prices, we're not talking about speculation or market euphoria. We're talking about mathematical consequences of monetary decisions already made. Let me explain what I mean by mathematical consequences. Precious metals, particularly gold and silver, have served as monetary anchors for millennia because they possess specific characteristics. They're scarce, durable, divisible, and most importantly, they cannot be created through policy decisions. When governments and central banks create currency at unprecedented rates, the relationship between that currency and tangible assets with fixed supply must eventually adjust. This isn't controversial. This is mathematical reality. The only questions are timing, magnitude, and the path the adjustment takes. Right now, we're seeing early signals that this adjustment may be beginning. Let's examine history, because markets don't operate in a vacuum. Between 1970 and 1980, gold prices increased from $35 per ounce to over $800 per ounce. That's not a 22-fold increase in the value of gold. That's a reflection of the dollar's loss of purchasing power during a period of monetary instability. During the same decade, silver climbed from roughly $1.50 to $50 per ounce, a 33-fold increase at its peak. What caused these moves? A combination of monetary policy errors, inflation, geopolitical instability, and the breaking of gold's link to the dollar in 1971. The circumstances were different then, but the underlying dynamic was identical to what we're discussing now: a loss of confidence in fiat currency systems leading to a flight toward tangible assets with intrinsic value. Here's what most people miss when they study that period. The move wasn't linear. It wasn't smooth. There were multiple false starts, brutal corrections, and extended periods where it seemed the rally had ended before it ultimately resumed. Investors who bought gold at $200 in 1975 watched it fall back to $140 before eventually climbing to $800. Many sold at a loss during the correction, convinced they had missed the top. This is the pattern. Precious metals follow during monetary crises: violent moves upward, severe corrections that shake out weak hands, then resumption of the primary trend. Understanding this pattern is crucial because it determines whether you'll have the emotional fortitude to navigate what may be coming. Now let's look at the 2000 to 2011 period. Gold began that cycle around $250. It peaked at $1,900. Silver went from roughly $4 to nearly $50 again. What drove those moves? The aftermath of the dot-com bubble, the 2008 financial crisis, and the first round of quantitative easing? Central banks creating money on a scale previously unimaginable. Notice the pattern. Monetary instability leads to precious metals appreciation. Not immediately, not in a straight line, but inevitably. Here's the critical insight. Both previous cycles occurred when global debt was a fraction of current levels. Both occurred when central bank balance sheets were measured in billions, not tens of trillions. If precious metals reach those levels under those conditions, what happens when the conditions are exponentially more severe? This is the question driving current analysis. Let's talk about something most investors overlook: the physical supply dynamics of precious metals, particularly silver. Silver occupies a unique position in the commodity world. It's both a monetary metal and an industrial metal, and this dual nature creates supply-demand dynamics unlike anything else. Global annual silver production is roughly 800 million ounces. Total above-ground silver available in investable form, meaning bars and coins held by investors and institutions, is estimated at around 2 billion ounces, though exact figures are debated. Here's where the math becomes interesting. The total value of all investment-grade silver in the world at current prices is roughly $50 to $60 billion. Compare that to the bond market at over $130 trillion. Compare it to the stock market at over $100 trillion. Compare it to global real estate at over $300 trillion. If even a small percentage of capital currently deployed in traditional assets seeks safety in physical silver during a monetary crisis, the available supply could be absorbed rapidly. We're not talking about billions of dollars entering the silver market. We're talking about potentially trillions seeking a haven that can only accommodate billions without dramatic price adjustment. This is the supply-demand imbalance that creates the mathematical possibility of silver reaching prices that seem absurd today. Gold faces similar dynamics, though with different specifics. Annual gold production is around 3,000 tons. Total above-ground gold in all forms is estimated at roughly 200,000 tons. The gold market is significantly larger and more liquid than silver, but it faces the same fundamental issue: a fixed supply meeting potentially unlimited fiat currency creation. Central banks understand this, which is why they've been net buyers of gold for over a decade, adding thousands of tons to their reserves. When the institutions tasked with managing national currencies are accumulating the very asset that serves as an alternative to those currencies, that signal deserves attention. Now we need to discuss the uncomfortable reality that creates the conditions for extreme price scenarios. The global financial system is caught in what economists call a debt trap. This isn't controversial or conspiratorial. This is acknowledged by central bankers and finance ministers, though they describe it in carefully chosen language. Here's the simplified version. Global debt is so large that servicing it at historically normal interest rates would bankrupt governments, corporations, and consumers simultaneously. This forces central banks into an impossible position. They must keep rates low enough to prevent default cascades, but doing so encourages more debt creation and fuels asset bubbles, making the ultimate problem worse. They're trapped between two choices, both bad. Allow interest rates to rise to historically normal levels and trigger immediate crisis, or maintain artificially low rates and guarantee a larger crisis later. What does this have to do with precious metals prices? Everything. When you're trapped between two bad choices, you eventually stop choosing and let circumstances choose for you. That's when loss of control occurs. That's when currency confidence erodes. That's when people flee to assets that exist outside the system. The scenario that takes silver to $300 or $500 or gold to $8,000 isn't one where everything is fine and investors simply decide precious metals are a good trade. It's a scenario where confidence in the current monetary system suffers a significant shock, and investors simultaneously realize that the traditional safe havens, government bonds, reserve currencies, are the source of the problem, not the solution. In that environment, the limited supply of physical precious metals meets virtually unlimited demand from people trying to preserve purchasing power. Prices don't rise gradually. They gap upward. Premiums over spot prices explode. Physical metal becomes difficult to acquire at any price. These are the conditions that create the price spikes we're discussing. Has this happened before? Yes. Is it happening now? Not yet. Could it happen in the current environment? The structural conditions are in place. Let's shift to something equally important but less tangible: collective psychology. Markets are not computers calculating fair value. Markets are millions of humans making decisions based on fear, greed, hope, and anxiety. In precious metals, psychology plays an outsized role because these assets don't generate cash flow or earnings. Their value is entirely derived from collective perception of their utility as stores of value and monetary alternatives. This creates interesting dynamics. When precious metals enter bull markets, they tend to be ignored in the early stages. The general investing public dismisses the initial moves as temporary or irrelevant. As prices continue rising, curiosity builds. Financial media begins covering the moves, Analysts who previously ignored the sector start publishing research. This is when the psychological transition begins. Early investors who accumulated positions feel validated. They become more vocal. Success stories circulate. FOMO, fear of missing out, starts to spread among retail investors. At some point, the psychology flips from skepticism to belief, and that's when price acceleration occurs. We saw this pattern in the late 1970s. We saw it again from 2009 to 2011. In both cases, the final phase of the bull market was characterized by near vertical price moves that seemed to defy gravity until they ended. Understanding this pattern is crucial because it tells you two things. First, the most dramatic gains occur in the final phase, when psychology shifts from cautious accumulation to enthusiastic buying. If you exit too early out of fear, you miss the most profitable period. Second, those vertical moves always end badly for those who buy near the peak. When psychology reverses, the decline is equally violent. This is why discipline matters more than market timing. The investors who profit from these cycles aren't the ones who perfectly time tops and bottoms. They're the ones who accumulate during periods of skepticism, hold through volatility, and exit systematically when euphoria becomes excessive. Which brings us to a critical question. Where are we in the current cycle? Precious metals have been rising, but they haven't yet captured mainstream attention. Financial media coverage remains moderate. The general investing public is still largely focused on stocks, real estate, and cryptocurrencies. This suggests we're in the early to middle phase of a potential cycle, not the manic final phase. If, and this is a significant if, the structural forces we've discussed do push metals toward the extreme price levels in question, the psychological acceleration hasn't yet occurred. That has implications for strategy. Let me give you the specific indicators that matter if you're trying to understand whether these scenarios are becoming more or less likely. Watch real interest rates. Real interest rates are nominal rates minus inflation. When real rates are negative, meaning inflation exceeds interest rates, precious metals historically perform well because holding cash loses purchasing power. Central banks fought to raise rates in 2022 and 2023, trying to combat inflation. But debt levels constrain how high they can raise rates without breaking something. Watch for the inevitable reversal when economic pressure or financial instability forces them to cut rates again while inflation remains elevated. Monitor currency volatility. Confidence in fiat currencies is the fundamental factor underlying precious metals demand. Increased volatility in currency markets, particularly in major reserve currencies, signals growing instability. The dollar's role as global reserve currency has been questioned more openly in the past 3 years than in the previous 50. De-dollarization efforts by major economies, though slow, represent a structural shift with profound implications for dollar demand and consequently dollar purchasing power. Track central bank gold purchases. As mentioned earlier, central banks have been net buyers of gold. The scale of purchases matters. If purchases accelerate significantly, it signals growing concern among the institutions most informed about monetary policy. Observe credit spreads and financial stress indicators. Precious metals often begin major moves before visible crisis occurs, not after. Widening credit spreads, increasing commercial real estate distress, banking sector instability. These create the conditions that force central bank intervention, which ultimately undermines currency confidence. Watch the velocity of money. This technical indicator measures how quickly money changes hands in the economy. Low velocity has suppressed inflation despite massive money creation. If velocity increases, inflation accelerates, real rates stay negative longer, and precious metals benefit. Pay attention to geopolitical instability. Wars, trade conflicts, sanctions, and international tensions all increase demand for assets perceived as neutral stores of value outside any single nation's control. These indicators don't predict with certainty. They provide context for understanding whether the probability of extreme scenarios is increasing or decreasing. If you currently hold precious metals, you're facing specific questions and challenges. First, understand that volatility is the price of admission. If you can't tolerate significant percentage swings in value, if seeing your positions decline 30 or 40% would cause you to sell in panic, then your position size is too large. The path to $300 silver or $8,000 gold, if it occurs, will not be smooth. There will be multiple corrections of 30 to 50%. These corrections are designed by market structure to shake out weak hands. Your challenge is determining whether you have the emotional fortitude to hold through these corrections. Here's a framework for thinking about position sizing and psychology. Divide your precious metals holdings into 2 categories mentally: core position and trading position. Your core position is metal you've committed to holding through volatility. This is your monetary insurance, your hedge against systemic risk. You don't check its value daily, you don't sell it during corrections. It's there to preserve purchasing power over years or decades, not to generate trading profits. The appropriate size for a core position depends on your overall wealth and risk tolerance, but for most investors, somewhere between 5 and 15% of investable assets provides meaningful protection without creating excessive concentration risk. Your trading position, if you choose to have one, is metal you're willing to sell during price spikes and potentially rebuy during corrections. This position requires more active monitoring and stronger emotional discipline. Most investors should avoid having a trading position because it requires skills and temperament most people don't possess. Here's what you should not do as an existing holder. Don't leverage your positions. The volatility in precious metals will eventually trigger margin calls if you're using borrowed money. This forces selling at the worst possible time. Don't panic sell during corrections. Every major precious metals bull market includes multiple corrections that convince investors the trend has ended. If your position size is appropriate, you should be able to hold through these. Don't expect linear progress. There will be months or even years where your positions decline or move sideways while other assets outperform. This is normal and doesn't invalidate the long-term thesis. Don't ignore position rebalancing. If precious metals rise dramatically and become 30 or 40% of your net worth, that's excessive concentration regardless of your bullish thesis. Systematic rebalancing protects against both downside risk and the psychological temptation to hold too long. And perhaps most importantly, don't confuse unrealized gains with realized wealth. Paper profits mean nothing until they're secured. Have a plan for how you'll recognize when the cycle is approaching maturity. Historical precedent suggests that when precious metals dominate financial media, when your neighbors are discussing them, when new retail-focused precious metals companies are launching and advertising heavily, the cycle is probably in its final phase. If you don't currently hold precious metals and are considering entering these markets, you face different challenges. The first question is whether you should participate at all. Precious metals are volatile, non-income producing assets that can decline significantly and remain underwater for years. They're not appropriate for everyone. You should only consider precious metals if you understand and accept several realities. First, you might be early. The scenarios we're discussing might not unfold for years, or they might not unfold at all. Can you accept holding an asset that potentially underperforms while you wait? Second, you'll face ridicule. Precious metals investors are often dismissed as paranoid or old-fashioned. Can you maintain conviction when your strategy is unpopular? Third, timing entry is nearly impossible. You'll almost certainly not buy at the bottom. Can you accept that your positions might immediately decline? If you can accept these realities, here's how to think about entry strategy. Don't attempt to time the market perfectly. Dollar cost averaging, systematically purchasing set amounts on a regular schedule, removes emotion from entry decisions and ensures you accumulate at various price points. Start with a smaller allocation than you ultimately intend to hold. This gives you dry powder to add to positions if prices decline, and it limits regret if you're entering near a temporary top. Prioritize physical metal over paper proxies. ETFs, mining stocks, and futures contracts have their place, but they introduce counterparty risk and systemic risk. Physical metal in your possession is the purest expression of the thesis we're discussing. Understand premiums and storage costs. Physical metal trades at premiums over spot prices, particularly silver. These premiums expand during high demand. Factor this into your calculations. Consider the ratio between gold and silver. Historically, silver outperforms gold during precious metals bull markets, but underperforms during bear markets. It's more volatile in both directions. The gold to silver ratio, how many ounces of silver equal 1 ounce of gold, currently sits around 70 to 80. Historically, this ratio has compressed to 50 or even lower during silver bull markets. This ratio compression is one reason some analysts believe silver has more upside potential than gold in percentage terms. But don't let potential returns cloud judgment about risk. Higher potential returns come with higher volatility and risk. Diversify within the sector if your allocation is significant. Physical metal, mining stocks, and streaming companies provide different risk-return profiles. Mining stocks offer leverage to metal prices, but carry operational and management risk. Streaming companies provide metal price exposure with less operational risk than miners. And critically, have an exit strategy before you enter. Decide in advance what conditions would cause you to reduce or eliminate positions. This might be a certain price level, a change in macroeconomic conditions, or a specific time horizon. Without predefined exit criteria, you'll make emotional decisions at the wrong times. Let's be direct about the mistakes that destroy wealth in precious metals markets. Mistake number 1, investing money you need for living expenses or near-term obligations. Precious metals can decline sharply and remain depressed for extended periods. If you need to sell during a downturn to meet expenses, you'll realize losses at the worst time. Only invest capital you won't need for at least 5 years, preferably longer. Mistake number 2, using leverage or margin to amplify positions. This is the fastest way to financial destruction in volatile assets. Leverage magnifies losses just as it magnifies gains. and margin calls force selling at bottoms. If you're using borrowed money, you're gambling, not investing. Mistake number 3, expecting immediate results and selling during inevitable corrections. Every precious metals bull market includes multiple corrections of 30 to 50%. These corrections feel like the trend has ended. They're designed to shake out weak hands. If you sell during these, you'll miss the resumption of the trend. Mistake number 4, following the crowd and buying during euphoric phases. The most dangerous time to enter precious metals is when everyone is talking about them, when media coverage is constant, when your relatives are asking how to buy silver. These conditions typically mark late-stage bull markets followed by brutal corrections. Mistake number 5, ignoring tax implications. In many jurisdictions, precious metals are taxed as collectibles at higher rates than stocks or bonds. Understand the tax treatment before you invest, and factor it into your calculations. Mistake number 6, failing to secure physical holdings properly. If you hold physical metal, security matters. Home storage requires proper safes and discretion. Bank safe deposit boxes have their own risks. Professional vaulting services provide security, but introduce counterparty considerations. Think through storage before you buy. Mistake number 7, chasing tips and rumors. Precious metals markets are full of manipulation claims, conspiracy theories, and supposed insider information. Focus on fundamental factors you can verify and understand. Ignore noise. Mistake number 8, confusing investment with gambling. If you're checking precious metals prices multiple times per day, if you're experiencing anxiety about short-term moves, if you're losing sleep over your positions, you're not investing. You're gambling, and the house always wins eventually. Mistake number 9, becoming ideologically attached to positions. Some precious metals investors develop almost religious conviction in their thesis. They ignore contrary evidence and become unable to adjust when conditions change. Markets don't care about your beliefs. Maintain intellectual flexibility. Mistake number 10, neglecting overall financial foundation. Precious metals might be part of a sound financial strategy, but they're not a substitute for fundamental financial health. If you have high interest debt, no emergency fund, or insufficient insurance, address those issues before speculating on metal prices. These mistakes aren't theoretical. They're patterns that repeat in every market cycle, destroying wealth for those who commit them while creating opportunities for those who avoid them. We need to address a complexity that confuses many investors: how precious metals perform in different macroeconomic scenarios. The common assumption is that precious metals only perform well during inflation. This is incomplete. Precious metals perform well during monetary instability, regardless of whether that instability manifests as inflation or deflation. In inflationary environments, metals preserve purchasing power as currency loses value. This is straightforward and well understood. But metals also perform during deflationary credit collapses, though for different reasons. During deflation, the real value of debt increases while the nominal value of most assets declines. This creates defaults, bankruptcies, and financial system stress. Central banks respond to deflationary credit collapses with massive monetary expansion. This expansion might not immediately cause consumer price inflation, but it undermines confidence in currency and drives demand for alternative stores of value. The 2008-2011 period demonstrated this dynamic. The initial crisis was deflationary. Credit was contracting, assets were declining. Yet gold rose from $700 to $1,900. Why? Because the central bank response to deflation was so aggressive that it created expectations of future inflation and immediate concerns about currency debasement. This is the environment we're potentially facing now. Deflation in credit and asset markets triggering inflation and monetary response. Precious metals benefit in both scenarios, not because they're perfect investments, but because they're alternatives to a monetary system under stress. Understanding this dynamic prevents the mistake of selling metals because deflation is deflationary for everything. It's not. It's deflationary for leveraged assets. It's often bullish for monetary alternatives. Let's briefly discuss precious metals mining stocks, because they deserve separate consideration. Mining stocks provide leveraged exposure to metal prices. When gold rises 20%, quality gold miners might rise 50 or even 100%. This leverage works in both directions. When gold falls 20%, miners might decline 40%. Mining stocks also carry risks. Physical metal doesn't. Operational risks, management risks, geopolitical risks, currency risks, and equity market risks. During the 2008 financial crisis, gold fell from $1,000 to $700, a 30% decline. Gold mining stocks fell 60 to 70% because they were treated as equities during a broad market collapse. This pattern repeats. Mining stocks correlate with both metal prices and general equity markets. During financial stress, both correlations work against you simultaneously. However, during strong precious metals, bull markets, mining stocks can dramatically outperform physical metal. From 2000 to 2011, physical gold roughly quintupled. Quality gold miners rose 10 to 20 times. If you have strong conviction in a major precious metals bull market and can tolerate extreme volatility, mining stocks offer higher return potential than physical metal. If your thesis is primarily defensive, preserving purchasing power during monetary instability, physical metal is more appropriate. Many sophisticated investors hold both: physical metal as core monetary insurance and a smaller allocation to mining stocks for additional upside potential. If you pursue this strategy, understand that mining stocks should be approached with the same rigor you'd apply to any equity investment. Management quality, balance sheet strength, reserve life, and production costs all matter. Let me address something rarely discussed in investment analysis: the psychological toll of holding volatile assets through major price swings. If silver reaches $300, it won't do so smoothly. There will be moments where it's up 200% from current levels, then declines 50% in weeks. If you're not psychologically prepared for this volatility, you'll make costly mistakes at critical moments. How do you prepare psychologically? First, never hold positions large enough to cause genuine anxiety. If watching prices causes stress, your position is too large. Reduce it until you can view declines with equanimity. Second, understand that volatility is normal and expected, not a sign something has gone wrong. Volatility is the mechanism by which weak hands transfer assets to strong hands at favorable prices. Third, recognize that your emotional responses are predictable and manageable. Fear during declines and greed during advances are universal human responses. Expect them. When you feel them, pause before acting. Fourth, maintain perspective by zooming out. Daily and weekly price movements are noise. Monthly and yearly trends are signal. If you're checking prices daily, you're focusing on noise. Fifth, have trusted advisors or communities for reality checking during emotional moments. Isolation amplifies emotional responses. Discussing concerns with level-headed people provides perspective. Sixth, remember that this is one component of your overall financial picture, not your entire strategy. Even if precious metals perform poorly, you have other assets and income sources. Even if they perform extraordinarily well, they're just one element of your wealth. Seventh, recognize that the scenarios we're discussing, while possible, are not guaranteed. Maintain intellectual humility. Markets have a way of humbling those who become too confident in any thesis. The investors who successfully navigate volatile markets aren't smarter or better informed. They're more disciplined and better prepared psychologically. Prepare for volatility before it arrives. Once you're in the midst of it, emotional preparation is too late. Let's discuss something most precious metals bulls don't want to contemplate: how and when to exit. If the scenarios we've discussed do unfold, if metals reach multiples of current prices, there will be a moment when the cycle matures and reverses. How do you recognize that moment? History provides clues. Major precious metals, bull markets end with specific characteristics. First, media saturation. And when precious metals dominate financial news, when mainstream publications run cover stories, when your neighbors are discussing them, the cycle is probably advanced. Second, retail enthusiasm. When new companies launch to serve retail investors, when precious metals dealers can't keep inventory, when premiums over spot prices explode, these signal late-stage dynamics. Third, valuations becoming extreme even by historical standards. When gold reaches multiples of all-time highs adjusted for inflation, when silver's ratio to gold compresses beyond historical norms, these suggest excessive enthusiasm. Fourth, alternative narratives emerging to justify higher prices. Late in cycles, new theories appear explaining why this time is different and why prices can go much higher. These narratives are usually rationalizations for already extended valuations. Fifth, leveraged speculation becoming common. When average investors start using margin and leverage to amplify returns, when trading volume in futures and options explodes, speculation has likely reached dangerous levels. Sixth, contradictory indicators appearing. When precious metals continue rising despite factors that should be negative, rising real interest rates, falling inflation, currency strength, it suggests momentum has disconnected from fundamentals. These indicators don't predict exact tops, but they identify periods of elevated risk where reducing position size becomes prudent. The goal isn't to sell at the exact top. That's impossible. The goal is to sell into strength, while buyers are still enthusiastic, not into weakness after the trend has already reversed. A systematic approach serves most investors better than attempting perfect timing. Consider taking profits in tranches as prices rise, selling 10 to 20% of holdings at predetermined levels on the way up, securing gains systematically rather than trying to time the peak. This approach ensures you benefit from major moves while protecting against the risk of holding too long. Let's step back and consider what extreme precious metals prices would actually signify. Silver at $300 to $500, gold at $8,000. Now, these aren't just big numbers. They're symptoms of profound systemic dysfunction. For precious metals to reach these levels, something significant must break in the global monetary system. Either inflation spirals beyond central bank control, or a cascade of defaults forces such aggressive monetary response that currency confidence collapses, or geopolitical upheaval disrupts the international monetary order. In other words, the scenarios that create wealth for precious metals holders also create hardship broadly. This isn't something to cheer for. This is something to prepare for while hoping it doesn't occur. If you profit from extreme precious metals prices, you'll be doing so in an environment where many others are struggling. Your neighbors, your community, perhaps even your own standard of living in non-financial ways. This is why precious metals should be viewed primarily as insurance, not as a path to easy wealth. Insurance serves a crucial function. It protects against adverse outcomes. But you don't hope for your house to burn down so you can collect insurance payments. You hope the insurance never proves necessary. Similarly, holding precious metals protects purchasing power during monetary instability, but you should hope the extreme scenarios don't unfold even while preparing for the possibility. This mindset, preparing for the worst while hoping for the best, creates the psychological foundation for sound decision-making. It prevents the perverse hoping for crisis that afflicts some precious metals investors. It maintains perspective about the human cost of financial instability. It keeps you grounded while navigating volatile markets. We've covered significant ground. Let me bring this together. The scenarios mentioned in this video's title, silver reaching $300 to $500, gold reaching $8,000, are not predictions. They're possibilities that emerge from specific structural conditions currently present in the global financial system. These conditions include unprecedented debt levels, central banks caught between impossible choices, negative real interest rates in many periods, currency instability, and geopolitical tensions. These conditions create the mathematical possibility of precious metals appreciating dramatically as investors flee unstable fiat currency systems for tangible stores of value with fixed supply. Historical precedent confirms that such moves are possible. They've happened before during periods of monetary instability. The current conditions are more severe than previous episodes. However, possibilities are not certainties. Markets can remain irrational or stable longer than you can remain solvent. Timing these moves is nearly impossible. Volatility along the way will test your resolve. If you choose to position for these scenarios, do so with appropriate position sizing, mental preparation for volatility, clear exit criteria, and emotional discipline. If you're already positioned, avoid the mistakes that destroy wealth: leverage, panic selling during corrections, overconcentration, and ideological attachment to positions. If you're not positioned and choose not to be, that's also a legitimate decision. These investments aren't appropriate for everyone. They require specific temperament and circumstances. What matters most isn't whether you hold precious metals. What matters is whether you understand the forces shaping the financial environment and whether you're prepared for multiple possible outcomes. The disciplined investor prepares for various scenarios without being certain which will occur. The disciplined investor maintains diversification. The disciplined investor focuses on what can be controlled, position sizing, risk management, emotional responses, rather than what cannot be controlled, which is market outcomes. Whatever scenario ultimately unfolds, your financial security depends less on predicting the future perfectly and more on responding to whatever emerges with discipline, flexibility, and emotional balance. The months and years ahead will likely bring significant volatility across all asset classes. This volatility will create both risks and opportunities. Those who navigate it successfully will be those who prepared intellectually and psychologically, who maintained discipline when others panicked, and who remained flexible when conditions changed. The extreme price scenarios we've discussed may or may not occur, but the principles of sound investing, proper position sizing, risk management, emotional discipline, and long-term thinking apply regardless of which scenario unfolds. As you consider your strategy, remember that wealth preservation matters more than wealth creation. The first rule of investing is not to lose money. The second rule is to remember the first rule. Precious metals, if used appropriately, can serve as one component of a strategy focused on preservation first, growth second. They won't make you rich overnight. They might not make you rich at all, but they might preserve purchasing power during periods when other assets fail to do so. That's their value proposition. Optionality during uncertain times, insurance against monetary instability, and participation in potential upside if extreme scenarios unfold. Whether you choose to allocate to precious metals or not, I hope this analysis has provided a framework for thinking clearly about the factors at play and the decisions you face. The financial landscape is shifting. The rules that governed the past several decades may not govern the next several. In this environment, awareness, preparation, and discipline matter more than predictions. Stay informed, stay disciplined, stay rational. And whatever decisions you make them from a place of understanding rather than fear or greed. Thank you for watching.